Before we begin, it's crucial to understand that the information in this presentation is for educational and informational purposes only. I am not a financial advisor, and this video does not constitute financial, investment, or trading advice. Trading foreign exchange on margin carries a high level of risk and may not be suitable for all investors. The high degree of leverage can work against you as well as for you. Before deciding to trade foreign exchange, you should carefully consider your investment objectives, level of experience, and risk appetite. The possibility exists that you could sustain a loss of some or all of your initial investment, and therefore you should not invest money that you cannot afford to lose. All trading strategies are used at your own risk. You're staring at a chart. It's a chaotic dance of red and green, a mess of lines and indicators that are supposed to mean something, but right now they just look like digital spaghetti. Your mouse hovers over the buy button, then the sell button. A voice in your head screams, "Do something," while another whispers, "What if you're wrong?" That feeling, that analysis paralysis, is the silent account killer for millions of aspiring traders. You're trying to decipher a language spoken by global banks and hedge funds, and you're doing it alone. Now consider this. Every single day, over $7.5 trillion moves through the global foreign exchange market. That's not a year, not a month. That's every 24 hours. It's a financial flow so massive it's almost incomprehensible, dwarfing every stock market on the planet combined. In the middle of this colossal river of money, it's easy to feel like a tiny rowboat in a hurricane, tossed around by waves you can't see coming. So how do you navigate it? How do you move from guessing and gambling to making informed strategic decisions? What if you had a navigator, a professional guide whispering in your ear, pointing out the currents, the potential hazards, and the clear channels forward? That, in essence, is the core idea behind Forex Trading Signals. And in this video, we are going to pull back the curtain on one of the most powerful, yet dangerously misunderstood, tools in modern trading. We're not just going to give you a dictionary definition, we are going to dissect them. By the time you're done watching, you will understand exactly what they are, the intricate mechanics of how they function, the different types you'll encounter in the wild, and most critically, how to begin developing the skill to distinguish a potentially valuable analytical tool from a worthless or even predatory scam. We're going to arm you with the knowledge to cut through the hype and see these tools for what they really are. Let's be real. The dream of financial independence through trading is powerful. It's a picture of freedom, of controlling your own destiny. But the path is littered with blown accounts and broken dreams, primarily because people jump in without a map. They try to learn everything at once: technical analysis, fundamental analysis, market sentiment, risk management, and they get completely overwhelmed. I've seen it happen 1,000 times. They're trying to become a master chef, a world-class mechanic, and a Formula One driver all at the same time, without ever having taken a single lesson. So what is a Forex signal? Forget all the complex jargon for a moment. Think of it like a recipe from a professional chef. You want to cook a Michelin star meal, but you don't know how. The chef sends you a simple, clear instruction card. It doesn't just say cook steak. It says, ingredient: USDA prime ribeye 1.5 inches thick. Action sear. Pan temperature: 450 degrees Fahrenheit. Cook time: 4 minutes per side for medium rare. It gives you everything you need to execute the plan. A Forex signal is that exact same concept, but for the financial markets. It's a concise, actionable piece of information that suggests a specific trade. It's a recommendation generated by a human analyst, a team of experts, or a sophisticated automated system, designed to take the guesswork out of your trade execution. It strips away the noise and says, based on our analysis, here is a potential opportunity. A professional, high-quality signal will almost always contain 5 key pieces of information. Let's break them down one by one because understanding these components is non-negotiable. First, the asset. This is the ingredient in our recipe. Tells you exactly what you are trading. In Forex, this is always a currency pair, like the euro versus the US dollar, written as euro to US dollar, or the British pound versus the Japanese yen, pound sterling to Japanese yen. The signal needs to be crystal clear. There's no ambiguity. It's not look at the dollar. It's we are focused on this specific pair. Euro to US dollar. Second, the action. This is the most basic instruction. Are we buying or are we selling? If the signal says buy or long, it means the analyst believes the value of the first currency in the pair is going to rise against the second. So for a euro to US dollar buy signal, the expectation is the euro will strengthen or the dollar will weaken. If the signal says sell or short, it's the exact opposite. The analysis suggests the first currency will fall in value relative to the second. Simple, direct, and to the point. Third, and this is where it gets more tactical, is the entry price. A good signal doesn't just say buy euro to US dollar now. The market moves every millisecond. Now is a constantly changing target. Instead, a precise signal will provide a specific price level. It might say, buy euro to US dollar at 1.0750. This is the chef telling you not to put the steak in a cold pan. You wait for the conditions to be perfect. This allows you to set what's called a pending order, so your trading platform can automatically enter the trade for you, if and when the market hits that exact price. You don't have to be glued to the screen waiting for the perfect moment. Fourth, we have the most important component of all. If you remember nothing else, remember this one, the stop loss. The stop loss is your safety net. It is your emergency brake. It is the single most critical piece of risk management in any trade. It is a predetermined price level where your trade will automatically close at a loss. Let's say the entry price was 1.0750. A stop loss might be set at 1.0720. This means if you buy, but the market goes against you and drops to that price, the trade is automatically shut down. Your loss is capped. It prevents a single bat trade from wiping out your entire account. Any signal provider that does not give you a clear stop loss is not professional. They are reckless, and you should run in the other direction. Period. It's the equivalent of a chef giving you a recipe for a deep fryer but not telling you to have a fire extinguisher nearby. It's malpractice. And fifth, we have the take profit. This is the flip side of the stop loss. It's the predetermined price target where you want to exit the trade and lock in your potential gains. If you bought at 1.0750, the take profit might be set at 1.0850. If the market moves in your favor and hits that price, your platform automatically closes the trade, securing that profit. This helps remove greed from the equation, that destructive impulse to hold on for just a little more, only to watch the market reverse and erase all your gains. The stop loss protects you from catastrophic loss. The take profit protects you from your own greed. Together, they form the foundation of a disciplined trading plan. So to recap, asset, action, entry price, stop loss, and take profit. That's it. That's the anatomy of a trading signal. It's a complete trade plan, delivered in a simple, easy-to-understand package. It's a potential answer to that overwhelming feeling of staring at a chart with no idea what to do next. But this raises the most important question of all. Where do these signals actually come from? Who is this chef sending you the recipe? Is it some Wall Street genius with a supercomputer? Is it an advanced artificial intelligence running on a server farm? Or is it just some random person in their garage with a laptop and a YouTube channel? The answer is, it can be any of those. And understanding the source, the methodology, and the philosophy behind the signal is the real secret. It's the difference between using a tool that could potentially elevate your trading and falling for a marketing gimmick designed to do nothing but drain your wallet. And that's exactly what we're going to explore next. So let's pull back the curtain. Imagine you're trying to bake a complex, multi-layered cake for the first time. You could try to guess the ingredients, the measurements, the oven temperature. Or you could use a recipe. A trading signal at its core is a recipe for a potential trade. It's a concise, structured piece of information designed to be acted upon. It strips away the noise and gives you a clear set of instructions. Let's break down the anatomy of a typical Forex signal. Think of it like a set of GPS coordinates for the financial markets. It has 5 critical components. First, you have the currency pair. This is the what. Are we looking at the euro versus the US dollar, the British pound versus the Japanese yen? This is the battlefield, the specific market where the opportunity has been identified. Without this, everything else is meaningless. Second, the action. This one is simple, but it's the heart of the signal, buy or sell. Are we anticipating the price will go up, which means we go long or buy? Or do we expect it to go down, meaning we go short or sell? This single word dictates the entire direction of the proposed trade. Third, and this is where the precision comes in, is the entry price. This isn't just a vague, buy the euro now. A high-quality signal will give you a specific price level. For example, buy euro to US dollar at 1.0850. This is the exact point on the map where the signal provider's analysis suggests the most favorable point of entry exists. Acting too early or too late can dramatically alter the potential outcome of the trade. Fourth, and arguably the most important component for survival, is the stop loss. The stop loss, or SL, is your pre-planned exit strategy if the trade goes against you. It's the safety net. It's the automatic ejection seat. The signal might say, stop loss at 1.0820. This means if you buy at 1.0850, but the market unexpectedly turns and drops to 1.0820, your trading platform will automatically close the position for a small manageable loss. It's the mechanism that prevents one bad trade from wiping out your account. It's the disciplined, unemotional decision you make before you're in the heat of a losing trade. And finally, the fifth component is the take profit. The take profit, or TP, is the flip side of the coin. It's your target. It's the predetermined price at which you will exit the trade. And, if the market moved as anticipated, lock in your gains. The signal might say, take profit at 1.0910. If the price rises from your 1.0850 entry to this level, your trade automatically closes, and the profit is secured. It's the tool that helps combat greed, preventing you from holding on too long hoping for more, only to watch the market reverse and erase all your gains. So a complete signal looks something like this. Buy euro to US dollar at 1.0850. Stop loss at 1.0820. Take profit at 1.0910. It's a complete self-contained trade plan. The what, the direction, the entry, the defensive exit, and the offensive target. But here's the million-dollar question. Where do these numbers come from? Is someone just throwing darts at a chart? Is it a lucky guess? Not if it's a professional service. The generation of a signal is where the real work happens. It's the difference between a chef's recipe and a random list of ingredients. The numbers are the result of a deep analytical process. This process typically falls into three main categories. The first and most common is technical analysis. This is the art and science of reading charts. Analysts who use this method believe that all known information is already reflected in the price, and that history tends to repeat itself. They are like market detectives, looking for clues in the patterns of price movement. They use tools like trend lines to see the market's direction, support and resistance levels to identify price ceilings and floors, and chart patterns, formations like head and shoulders or double bottoms, that have historically suggested a certain outcome. They also use mathematical indicators like moving averages to smooth out price action, or the relative strength index, the RSI, to gauge if a market is overbought or oversold. A technical analyst might issue a signal because a currency pair has bounced perfectly off a long-term trend line. A classic pattern is forming, and an indicator is giving a strong confirmation. The second method is fundamental analysis. If technical analysts are the chart detectives, fundamental analysts are the economic journalists. They look at the big picture, the economic health and stability of a country, to determine the value of its currency. They're asking questions like, is the US economy growing faster than the Eurozone's? Is the Bank of England likely to raise interest rates, making the pound more attractive to investors? They pore over major economic reports, things like the non-farm payrolls report in the US, which is a huge indicator of economic health, or GDP figures, inflation rates, and retail sales. A major news event, like a surprise interest rate hike from the Federal Reserve, can send shockwaves through the market, and a fundamental analyst will generate a signal to capitalize on that expected movement. The third, and increasingly powerful, method is quantitative or algorithmic analysis. This is where the machines take over. In this world, powerful computers and complex algorithms, sometimes using artificial intelligence, sift through mountains of historical data. They look for statistical correlations, price discrepancies, and complex patterns that are completely invisible to the human eye. These systems can execute thousands of calculations per second, analyzing decades of market data to find a tiny statistical edge. An algorithmic signal might be generated because a specific set of 17 different market conditions, which has historically led to a 70% chance of a price increase over the next 4 hours, has just been met. Now, the reality is, the most robust signals don't come from just one of these silos. They come from a fusion. An expert human trader or a team of them will often use a combination of all three. They might see a compelling technical setup on the charts, a perfect bounce off a key support level. Then they'll check the fundamental calendar. They see a major economic announcement is coming up that they believe will support their technical view. Finally, their proprietary algorithm might be flagging the same currency pair for unusual market sentiment. When all three disciplines align, the technicals, the fundamentals, and the quantitative data, that's when they have the highest conviction. That's when the recipe is written and the signal is sent out. So when our new trader, Alex, receives that signal, Buy euro to US dollar at 1.0850. It's not just a random set of numbers. It's the endpoint of a rigorous analytical process. The provider saw a pattern, they checked the economic news, and their systems confirmed the potential. And this brings us to a crucial distinction that separates legitimate educational tools from potential scams. Transparency. A blind signal, which is just the numbers with zero context, forces you to trade on blind faith. You learn nothing in the process. You're just a passenger. But a high-quality signal provider often includes a brief rationale. We are buying euro to US dollar due to a bullish engulfing pattern on the 4-hour chart, bouncing off key support at 1.0840. The recent positive GDP data from Germany further supports euro strength. Now you're not just a passenger, you're a co-pilot. You can pull up your own chart, see the pattern they're talking about, and understand the logic. You start to learn why the trade is being considered. This is what transforms a signal service from a simple alert system into a powerful educational tool that can help you grow as a trader. You're not just getting the recipe, you're learning how to cook. So we've dissected the signal. We know its 5 core components, and we understand the immense analytical engine, the technical, fundamental, and quantitative analysis that works behind the scenes to generate it. We know what to look for, a complete plan with a rationale behind it. But knowing what a signal is and how it's made is only half the battle. This leads to the most critical question of all. Who is creating it? The source of the signal, the person, the company, or the algorithm behind that message can make all the difference between a calculated trade and a costly mistake. And that's where things get really interesting. So let's pull back the curtain. When that signal alert pings on your device, who or what is on the other end? The source of a signal isn't just a minor detail. It's the very foundation upon which its potential reliability is built. Broadly speaking, these sources fall into 3 main categories, each with its own distinct philosophy, strengths, and critical weaknesses. Think of them as the 3 archetypes of the signal world: the seasoned human analyst, the tireless automated system, and the powerful hybrid model. First, let's talk about the human analyst. Picture a seasoned trader, someone who has spent years, maybe even decades, with their eyes glued to charts. They've lived through market crashes, surprise interest rate hikes, and geopolitical turmoil. They don't just see lines and numbers. They see the story the market is telling. This is the maestro. Their signals are born from a deep, often intuitive, understanding of market dynamics. They combine multiple forms of analysis. They'll use technical analysis, looking at chart patterns, support and resistance levels, and indicators just like an algorithm might. But then they layer on something a machine struggles with: fundamental analysis. They're reading central bank reports, listening to press conferences, engaging the economic health of a country to understand the why behind a currency's movement. The biggest strength of the human analyst is adaptability. A purely automated system can be thrown into chaos by a sudden, unexpected event, a black swan event that defies historical data. The human analyst, however, can process this new information, understand its context, and adjust their strategy on the fly. They can read the subtle, intangible sentiment of the market, the collective fear and greed driving traders, in a way that code often can't. They bring a level of nuanced judgment to the table. The potential downside? They are human. They are susceptible to emotion, to psychological biases, to fatigue. A trader having a bad day might make a poor call. They might fall in love with a particular trade and hold on too long, or get scared out of a good position too early. Their capacity is also limited. One person can only track so many currency pairs effectively, and they can't be watching the market 24 hours a day. Their strategy can also be a bit of a black box. You're trusting their experience and judgment, which can be difficult to quantify or independently verify. Now let's shift gears to the complete opposite, the automated system. This is the machine. These are trading signals generated entirely by computer algorithms, often called trading bots or expert advisors, or EAs. These systems are built on a strict set of rules. For example, an algorithm might be programmed to send a buy signal for the euro versus the US dollar, only when a specific combination of technical indicators aligns perfectly. Say, the 50-day moving average crosses above the 200-day moving average while the relative strength index is below a certain level. The primary advantage here is the complete removal of human emotion. The algorithm doesn't feel fear. It doesn't get greedy. It will execute its programmed strategy with ruthless, robotic discipline, 24 hours a day, 5 days a week, without ever getting tired or distracted. It can scan dozens of currency pairs and timeframes simultaneously, analyzing vast quantities of data in milliseconds, a feat impossible for any human. The results, in theory, are based purely on statistical probability and historical performance. However, the machine has its own Achilles heel: rigidity. It can only do what it's been programmed to do. It has no common sense. If a sudden political crisis rocks the market, the algorithm doesn't know or care. It will continue to follow its pre-programmed rules, even if the fundamental context of the market has completely changed, which can lead to significant losses. These systems are also only as good as their design and the data they were tested on. A system that performed brilliantly on last year's market data might fail spectacularly in this year's different market conditions. The phrase "garbage in, garbage out" is critically important here. This leads us to the third and increasingly popular source, the hybrid model. You can think of this as the cyborg approach. It aims to combine the best of both worlds. In this setup, a company will use powerful, sophisticated algorithms to do the heavy lifting. These machines will scan the entire Forex market, 24/7, looking for potential trade setups that match a wide range of predefined criteria. They are the tireless scouts, searching for the needle in the haystack. But, and this is the key difference, the algorithm doesn't automatically send out the signal. Instead, it flags the potential opportunity for a team of human expert analysts. That team then conducts the final review. They apply their experience, check the fundamental context, and make sure the setup still makes sense in the current market environment. They provide the human oversight, the common sense filter that the machine lacks. Only after an expert gives the final green light is the signal sent out to subscribers. This synergy can be incredibly powerful. It leverages the machine's speed and data processing power, while mitigating its rigidity with human adaptability and nuanced judgment. The potential drawback is that it can still be subject to human error in that final stage of analysis. Furthermore, the quality of a hybrid service depends on two factors instead of one: the sophistication of their technology and the skill of their analysts. So you have the maestro, the machine, and the cyborg. Knowing which type of provider you're looking at is the first step. But it immediately raises a more pressing question. How do you know if any of them are actually any good? It's incredibly easy to claim success in the world of trading. It's much harder to prove it. This is where the concept of a verifiable track record becomes non-negotiable. Any legitimate signal provider, whether human, automated, or hybrid, should be able to provide a transparent, long-term history of their performance. And I don't mean a curated list of their biggest wins or a screenshot of a profitable account. That is a massive red flag. Anyone can cherry-pick winning trades and hide the losers. What you should be looking for is a record that is tracked and verified by a trusted, independent third-party service. Platforms like MIFSpook or FXBlue are common examples. These services connect directly to a provider's trading account via their broker and log every single trade in real time. Wins, losses, everything. It's like a financial audit. It prevents the provider from hiding losses or exaggerating gains. This third-party data allows you to analyze crucial metrics beyond just a simple win rate. You can see their average profit per trade, their average loss, the maximum drawdown, which is the largest peak-to-trough drop the account has experienced, and how long they've been trading this specific strategy. This level of transparency is what separates professional operations from amateur outfits. The willingness to be transparent is often a signal in itself. So we now understand the who behind the signal. We know it could be an experienced analyst using their intuition, a cold and calculating algorithm, or a powerful combination of the two. And we know that no matter the source, their claims demand independent verification. But this brings us to the core of the machine itself. What are they actually looking at? When that analyst sits down at their desk, or when that algorithm fires up, what specific patterns, what economic data, what secret sauce are they using to come up with that buy or sell recommendation? That's the engine room of signal generation, and we're about to open the door. Inside this engine room, there are three primary schools of thought, three core philosophies that drive nearly every single trading signal you will ever receive. They are the pillars of market analysis: the technical, the fundamental, and the sentimental. Most signal providers don't just pick one. They blend them together, creating their own unique analytical cocktail. Let's start with the most visual, the one you've probably seen on screens filled with jagged lines and colorful bars: technical analysis. At its heart, technical analysis is the art and science of reading the market's body language. The core belief is that all known information, every economic report, every news headline, every trader's hope and fear, is already reflected in the price on the chart. The chart therefore tells the story. A technical analyst isn't trying to predict the future based on what a central bank might do. They're looking at the price action itself, believing that history, in the form of patterns, tends to repeat itself. Think of it like being a crowd psychologist. You're watching a massive group of people, the market, and trying to figure out their collective mood and next move. You do this by looking for recurring behaviors. One of the most basic tools is identifying chart patterns. You might hear names like head and shoulders, double tops, or triangles. These aren't just random shapes. They represent a narrative of struggle between buyers and sellers. A double top, for instance, looks like the letter M. The price rallies to a peak, pulls back, rallies again to that same peak but fails to break through. It's the market's way of saying, we tried to go higher twice, but we just don't have the strength. For a technical analyst, that failure is a powerful clue, a potential signal that the price might be about to fall. They're reading the exhaustion written on the chart. Then you have technical indicators, which are essentially mathematical calculations based on price and volume, plotted onto the chart to give us more clues. The most famous is the moving average. It smooths out the chaotic, jagged price movements to show you the underlying trend, like looking at the general direction of a river, instead of every single little ripple. When a short-term moving average crosses above a long-term one, it's often interpreted as a sign that momentum is shifting upwards, a potential buy signal. Another popular one is the Relative Strength Index, or RSI. The RSI is like the market's heartbeat monitor or fever gauge. It measures the speed and change of price movements on a scale of 0 to 100. A reading above 70 is often considered overbought, like a rubber band stretched too far in one direction. It doesn't mean the price will snap back immediately, but it's a warning that the upward move might be running out of steam. Conversely, a reading below 30 is considered oversold, suggesting a potential bounce. A signal provider's algorithm might be programmed to look for a currency that is both overbought on the RSI and forming a bearish chart pattern like a double top. When those two conditions align, the probability of a successful trade, in their view, increases. That's a confluence, and that's what they hunt for. This brings us to the second pillar, fundamental analysis. If technical analysis is reading the market's body language, fundamental analysis is checking its health report. It ignores the charts and instead focuses on the real-world economic, social, and political forces that drive a currency's value. A fundamental analyst asks, what is the underlying health of this country's economy, and how does it compare to another's? The lifeblood of fundamental analysis is economic data. Every week, governments and private organizations release a flood of reports. Gross domestic product, GDP, which is the report card for the entire economy. Inflation numbers like the Consumer Price Index, CPI, which tells us how fast prices are rising, and retail sales, which show how much consumers are spending. The king of them all, especially for the US dollar, is the non-farm payrolls report. Released on the first Friday of every month, it reveals how many jobs were created or lost in the US. A number that's much better than expected suggests a strong economy, which could lead the Federal Reserve to raise interest rates to keep things from overheating. Higher interest rates make a currency more attractive to foreign investors seeking a better return on their money. So a strong NFP report often leads to a stronger US dollar. Signal providers who use fundamental analysis have teams of economists or sophisticated algorithms that pore over these releases, comparing the actual numbers to the forecasted numbers. The surprise is what matters. A big deviation from expectations can trigger a signal. But it's not just scheduled reports. It's also about central bank policy. When the chairman of the Federal Reserve gives a speech, the entire world listens. A single word or phrase that hints at future interest rate changes can send currencies soaring or tumbling. It's also about geopolitics. A surprise election, a new trade tariff, or an international conflict can inject massive uncertainty into the market, causing investors to flee to safe haven currencies like the Swiss franc or the Japanese yen. A fundamental signal provider is constantly monitoring this global chess match, trying to anticipate how these major events will impact the relative strength of one country's currency versus another's. The third pillar is a newer, more modern approach, sentiment analysis. If technical analysis is the body language and fundamental analysis is the health report, sentiment analysis is listening to the market's whisper network. It's about gauging the overall mood or feeling of traders. Are they generally bullish, bearish, or neutral on a particular currency? In the past, this was incredibly difficult to measure. Today, technology has made it possible. Signal providers use advanced algorithms to scrape social media platforms like Twitter, financial news websites, and trading forums. They analyze the language being used. Are words like surge, breakout, and strong trending? Or are words like crash, fear, and weakness dominating the conversation? By quantifying this collective mood, they can get a sense of whether the crowd is leaning too far in one direction, which can sometimes be a contrarian indicator. If absolutely everyone is bullish on the euro, it might mean there's no one left to buy, and the market is ripe for a reversal. A more professional tool for this is the Commitment of Traders, or COT report. This is a weekly report from the US government that shows the positions of different types of traders in the futures markets. Crucially, it breaks down what the large institutional players, the hedge funds, the big banks, the smart money, are doing. If you see that these major institutions are heavily buying the British pound while small retail traders are selling it, a sentiment-based signal provider might interpret that as a sign to follow the big money and issue a buy signal for the pound. So, how does this all come together to create a single signal? It's a process of synthesis. An automated system might have a rule that says, if the euro to US dollar chart shows a bearish head and shoulders pattern, and the RSI is above 70, and our sentiment analysis shows extreme bullishness on the euro, then scan the economic calendar. If a major US data release is scheduled in the next hour, then wait. If the US data comes out much stronger than expected, then trigger a sell euro to US dollar signal. A human analyst does the same thing but with intuition and experience. They might see the same technical pattern, feel the same over-optimistic sentiment in the market, but also remember what happened the last 3 times the Federal Reserve Chairman spoke in this exact tone. They combine the data on the screen with the experience in their head to make a judgment call. Let's walk through a concrete, hypothetical example. Imagine a signal provider is watching the Australian dollar versus the US dollar. Their technical algorithm notes that the price has been rejected from a key resistance level several times, and a bearish candlestick pattern has just formed. That's checkmark 1. Their fundamental analyst sees that data on the Chinese economy, Australia's biggest trading partner, has been looking weak, which is bad news for the Aussie dollar. Checkmark 2. Finally, their sentiment scanner shows that retail traders are overwhelmingly long on the Aussie, a classic contrarian signal. Checkmark 3. With the technicals, fundamentals, and sentiment all pointing in the same direction, the system flags a high probability setup. The chief analyst reviews it, agrees with the confluence of factors, and authorizes the signal. So you have the technicals, the fundamentals, and the sentiment all converging into a single actionable idea. It's a complex dance of data and interpretation. But once that signal is generated, once the algorithm pulls the trigger or the analyst hits send, what happens next? How does that critical piece of information get from their system to your phone? And when it arrives, looking like a cryptic line of code, sell pound sterling to Japanese yen at 185.50, SL 186.00, TP 184.50. What on earth are you supposed to do with it? That's the crucial link between the signal and the trade, and it's where we're going next. So let's crack the code. That string of letters and numbers that just buzzed your phone isn't gibberish. It's a language. It's a highly condensed, incredibly specific battle plan for a potential market move. Think of it less like a casual tip and more like a set of coordinates given to a fighter pilot. Every single number, every letter, has a precise and critical meaning. Let's use that example. Sell pound sterling to Japanese yen at 185.50, SL 186.00, TP 184.50. We're going to dissect this piece by piece until it's as easy to read as a grocery list. First up, sell pound sterling to Japanese yen. This is the most fundamental part of the instruction. It answers 2 questions: what are we doing and what are we doing it with? The what are we doing is sell. In the trading world, this means you are initiating a short position. The analysis behind this signal suggests that the price of the asset is more likely to go down than up. You're positioning yourself to potentially profit from a decrease in value. If the signal said buy, you'd be doing the opposite, anticipating a price increase. Simple enough. The second part, pound sterling to Japanese yen, is the what are we doing it with? This is the currency pair. GBP stands for the British pound, and JPY stands for the Japanese yen. Every Forex trade involves a pair of currencies, because you're always exchanging one for another. In this case, the signal is focused on the relationship between the pound and the yen. When you sell pound sterling to Japanese yen, You are simultaneously selling the pound and buying the yen. The core belief is that the pound will weaken relative to the yen. Think of it like a sports matchup. The signal provider has done their analysis and they're saying, in the game of pound versus yen, we think Team Yen is about to score. So right off the bat, we know the direction sell, and the playing field pound sterling to Japanese yen. Next, we have the most precise instruction. At 185.50, this is the entry price. This is the specific price on the chart at which the signal suggests the trade should be executed. The analysis indicates that 185.50 is a strategic level to enter the market. Now, this can mean one of two things. It could be a market order, meaning if the price is currently at or very near 185.50, the suggestion is to enter the trade immediately. Or it could be a pending order. This is an instruction you give to your trading platform to automatically execute the trade, only if and when the price reaches that specific level of 185.50. For instance, if the price is currently at 185.30, a sell limit order would be placed at 185.50, waiting for the price to rise up to that level before triggering the sell trade. The idea is that the price might pull back to a better entry point before continuing its expected downward move. The type of order often depends on the provider's strategy, but the number itself, 185.50, is the line in the sand. It's the designated entry point for the mission. Now we get to the most important parts of the signal, and I mean that sincerely. The entry is where the trade begins, but the next two components are what separate a structured trading idea from a wild gamble. Let's look at SL 186.00. SL stands for stop loss. This is your safety net. This is your pre-planned exit strategy for if the trade goes against you. A stop loss is an automatic order you place with your broker that says, if the trade moves against me and the price reaches this specific level, close my position immediately to prevent further losses. It's the financial equivalent of an ejector seat in a fighter jet. You hope you never have to use it, but you would never ever fly without it. In our sell pound sterling to Japanese yen example, we want the price to go down. So, if it starts going up instead, we're losing money. The stop loss is placed above our entry price, at 186.00. This means if we sell at 185.50, but the market reverses and the price climbs all the way up to 186.00, the trade automatically closes. We accept a small, calculated loss and live to trade another day. The distance between our entry, 185.50, and our stop loss, 186.00, is 50 pips. A pip is a standard unit of movement in Forex. For now, just think of it as 50 points. That 50-point distance represents our maximum calculated risk on this specific trade. Before you even enter the trade, you know exactly how much you stand to lose if you are wrong. This is the cornerstone of risk management. Without a stop loss, a losing trade could theoretically wipe out an entire account. A signal that doesn't include a stop loss isn't a signal. It's a lottery ticket. Finally, we have TP 184.50. TP stands for take profit. If the stop loss is your plan for being wrong, the take profit is your plan for being right. It's the mission objective. It's an automatic order that closes your trade once it reaches a certain level of profit. In our sell trade, we entered at 185.50, hoping the price would fall. The take profit is set below our entry, at 184.50. If the market moves in our favor and the price drops down to this level, the trade automatically closes, and the profit is locked in. The distance from our entry, 185.50, down to our take profit, 184.50, is 100 pips, or 100 points. Now let's put it all together and see the full picture. The signal is a complete plan. It says, we believe the pound sterling to Japanese yen is going to fall. The strategic point to enter a sell trade is at 185.50. If we are wrong and the price rises to 186.00, we will exit the trade for a calculated 50 pip loss. If we are right and the price falls to 184.50, we will exit the trade for a calculated 100 pip profit. Notice something powerful here? The potential profit, 100 pips, is twice the size of the potential loss, 50 pips. This is known as a risk-to-reward ratio. In this case, it's a 1-to-2 risk-to-reward ratio. For every $1 you are risking, you stand to make $2. This is a fundamental characteristic of many professional trading strategies. They seek out opportunities where the potential reward outweighs the potential risk. It means you don't have to be right every single time to see positive results over the long term. A system with a positive risk-to-reward ratio can, in theory, be profitable even if it only wins half of its trades. So, that cryptic message is now a clear, concise trading plan. It's not just sell this. It's sell this at this exact price, with this exact safety net in place, and this exact target in mind. It provides the what, where, when, and the two most important what-ifs. The provider has done the heavy lifting, the hours of chart analysis, the economic data review, the technical indicator alignment, and condensed it all into this single actionable line of text. The complexity of the market has been translated into a simple structured plan. But now comes the million-dollar question, or perhaps the $100 question depending on your account size. You've decoded the signal. You understand the plan. You see the entry, the stop, the target. You have the coordinates. But you're the one in the cockpit. You're the one who has to pull the trigger. How do you actually take these numbers and place a trade in the real world? What buttons do you press? And more importantly, do you just blindly follow every signal that comes in, no questions asked? Or is there another layer of decision-making, a final human check, that separates a novice from a seasoned trader? That's the bridge we need to cross next. From understanding the signal to executing the trade. The answer to that question is what separates traders who use signals as a crutch from those who use them as a springboard. It's the difference between being a passenger in your own financial journey and being the pilot. Let's imagine two traders both subscribe to the exact same, reputable signal service. We'll call them Adam and Beth. Adam receives a signal. It's a buy on euro to US dollar at 1.0850. The signal looks clean, it has a clear stop loss and take profit target. Adam's heart rate quickens. This is it. He sees the signal as a direct order from a higher authority. He opens his trading platform, and without a second thought, clicks buy. He doesn't look at his own charts. He doesn't check the news. The signal said buy, so he bought. He's outsourced his entire decision-making process. This is the path of least resistance, and for a while it might even feel liberating. No analysis, no stress, just follow the leader. Now let's look at Beth. She receives the exact same signal at the exact same time. Buy euro to US dollar at 1.0850. But her reaction is fundamentally different. Her heart rate stays steady. She doesn't see an order, she sees a proposal. A well-researched, data-driven hypothesis from a source she trusts, but a hypothesis nonetheless. Her job, as the CEO of her trading account, is to perform due diligence on this proposal before risking her capital. So what does she do? She begins a rapid but disciplined three-step validation process. This isn't about second-guessing the signal provider. It's about integrating their expertise with her own strategy and risk management. This is the professional's approach. Step 1 for Beth is the congruence check. She looks at the signal and asks one simple question. Does this trade idea fit my personal trading plan? You see, Beth has a plan. She knows which currency pairs she likes to trade, what time of day she's most effective, and what kind of market conditions suit her style. Maybe her plan is to only trade with the dominant trend on the daily chart. She pulls up her own euro to US dollar chart. Is the pair in an uptrend? If the signal is a buy, but her own higher-level analysis shows a strong bearish downtrend, that's an immediate red flag. The signal might be based on a short-term scalp, but it's directly fighting the powerful larger market current. For Beth, this might be enough to pass on the trade entirely. It's not congruent with her established rules. A signal that violates your personal trading plan is like a business proposal that goes against your company's core values. It doesn't matter how good it looks on paper. It's a non-starter. But let's say the signal passes this first check. The daily trend is up, and this buy signal aligns with it perfectly. Beth moves to step 2. The confirmation and confluence check. This is where she puts on her detective hat. The signal provider saw something that made them issue a buy alert. Beth's job is to see if she can find other, independent evidence on her own charts that supports the same conclusion. This is the principle of confluence. When multiple unrelated technical indicators all point to the same outcome, she might look for a classic chart pattern, like a bull flag or an inverted head and shoulders, forming near the entry price. She might check her favorite indicators. Is the relative strength index, or RSI, showing upward momentum? Or is it in overbought territory, suggesting the rally is exhausted? Are the moving averages crossed in a bullish formation? Is the proposed entry price bouncing off a key support level? or a significant Fibonacci retracement number. She's not looking for a perfect alignment of every indicator. She's looking for a weight of evidence. If the signal is telling her to buy, but her own chart shows the price is slamming into a major resistance level with bearish divergence on the MACD, that's a problem. The signal might be right, but the immediate context suggests the odds are stacked against it. It's like a trusted scout telling you a path is clear, but you can see with your own eyes that there's a roadblock just ahead. You trust your scout, but you also trust your own vision. By finding confluence, Beth isn't just blindly following. She is building her own conviction in the trade. This personal conviction is crucial for managing the trade psychologically when it's active. Assuming the trade passes the confirmation check, Beth moves to the final, and arguably most important step, the context and risk check. This is where she zooms out from the charts and looks at the wider world. A technically perfect trade setup can be instantly invalidated by a major news event. Beth pulls up an economic calendar. Is the Federal Reserve Chairman scheduled to speak in the next hour? Is there a major inflation report like the CPI about to be released? Trading around these high-impact news events is like sailing in a hurricane. The currents are unpredictable and violent. Many professional traders simply stand aside during these times. If the signal entry is right before a major news release, Beth might decide the risk of a volatile, unpredictable spike is too high. She'll pass. Beyond scheduled news, she also gets a feel for the overall market sentiment. Is the market in a risk-on mood, where investors are buying up assets like stocks and growth-oriented currencies? Or is it risk-off, with everyone fleeing to safe havens like the US dollar or the Japanese yen? A buy signal on a riskier currency pair might struggle if the entire market is in a state of panic. Context is king. Finally, she assesses the risk parameters proposed by the signal. The signal suggests a stop-loss 50 pips away and a take-profit 100 pips away. Beth doesn't just accept this. She customizes it to her own account. Based on her account size and personal risk tolerance, she has a rule to never risk more than 1% of her capital on a single trade. She calculates the position size. Does a 50-pip stop-loss fit within her 1% rule? If not, she has two choices. Either reduce the position size to make it fit, or pass on the trade if the position becomes too small to be worthwhile. She also looks at the stop-loss placement on the chart. Is it at a technically sound location like just below a recent swing low or a key support level? Or does it seem arbitrary? She might adjust the stop-loss by a few pips to place it in a more secure location, giving the trade a little more breathing room. She is the final arbiter of risk for her capital. Only after the signal has passed all three of these checks, congruence, confirmation, and context, does Beth place the trade. Now let's revisit Adam. He clicked buy instantly. The trade moves against him. He doesn't know why. He sees his account balance dropping and panic sets in. He trusts the signal, but his emotions are screaming at him. He closes the trade early for a small loss, just to stop the pain. A few hours later, the price turns around and hits the original take-profit target. He's frustrated. On the next signal, the same thing happens, but this time he holds on, trusting the provider. The trade keeps going against him and hits the stop-loss for a full loss. Now he's angry and confused. His trading is a chaotic emotional roller coaster, because he has no ownership of the decisions. Beth, on the other hand, placed the trade with full conviction. She understood why it was a good idea. When the trade moves against her a little, she remains calm. She knows where her invalidation point is, the technically sound stop-loss she placed herself. She understands the market context and is prepared for some fluctuation. Because she did her own due diligence, she has the psychological fortitude to manage the trade according to her plan, whether it ends up being a winner or a loser. She's not just following signals. She's building a robust trading methodology where signals are one powerful component. The signal is the starting gun, not the entire race. It's the expert tip-off that a potential opportunity exists. But the process of validating that tip-off, confirming it with your own analysis, checking it against the broader context, and tailoring the risk to your personal situation, that is the work. That is the skill. That is what transforms a simple signal from a lottery ticket into a strategic tool. So, the signal isn't just a set of numbers you plug into a machine. It's the beginning of a conversation. And your ability to participate in that conversation, to ask the right questions of the market and of the signal itself, determines the potential long-term outcome. But this raises another critical question. Once you've done your due diligence and you're ready to pull the trigger, what's the best way to actually enter the market? Do you just hit the buy button at any price? Or are there more precise, more strategic ways to execute the trade that can dramatically alter your results? The answer is a resounding no. Just hitting the buy or sell button the second a signal arrives is what's called a market order. You're essentially telling your broker, "Get me into this trade right now, at whatever the best available price is." And while that sounds simple and fast, it has a hidden danger called slippage. In a fast-moving market, the price you thought you were getting and the price your trade actually gets executed at can be different. It might only be a fraction of a cent, a few pips, but over many trades those fractions add up, eating away at potential profits. It's like trying to grab a specific item off a speeding conveyor belt. You might get it, but you might also grab the one right next to it. Professional traders and high-quality signal providers often operate with far more precision. They don't just throw orders at the market. They place them with surgical accuracy using specific instructions for their broker. These instructions are known as pending orders, and they are the fundamental tools for executing a signal-based strategy correctly. Think of it as the difference between shouting "buy" in a crowded room versus handing a sealed envelope to a courier with a specific set of instructions. Only open this and execute the order if these exact conditions are met. There are two primary categories of these pending orders: limit orders and stop orders. Understanding the difference is not just technical jargon. It's the core of controlling your entries and exits. First, let's talk about limit orders. A limit order is an instruction to buy or sell a currency pair at a specific price or better. The key phrase here is "or better." Let's say a signal comes in to buy the euro against the US dollar, or euro to US dollar. The current price is 1.0870, but the signal provider's analysis suggests that the price is likely to have a small dip, a little pullback, before it continues its upward journey. So the signal doesn't say "buy now." It says, "Place a buy limit at 1.0850. What does this mean? You are telling your broker, "I do not want to buy at the current price. I believe I can get a better deal. I only want you to execute my buy order if the price drops down to 1.0850. If the price does drop to that level, your order is triggered, and you enter the trade at a more favorable price than where it was when the signal came out. If the price never drops to 1.0850 and instead just shoots up, your order is never filled. You missed the trade, but you also avoided buying at a higher price. It's a strategy for patience, for traders who want to buy on a dip in an uptrend. The opposite is a sell limit. Imagine the market is rising, but your signal provider believes it's about to hit a ceiling, a resistance level, and then reverse. The signal might say, "Place a sell limit at 1.0900. You're telling your broker, "I want to short this pair, but I think I can get a better, higher price to sell at. Only execute my sell order if the price rises up to 1.0900. You're anticipating a reversal from a peak. So, limit orders are for getting in at a better price than the current market price. You're betting on a small reversal in your favor before the main move happens. Now let's look at the other side of the coin: stop orders. Sometimes they're called stop entry orders to avoid confusion. A stop order is an instruction to buy or sell a currency pair once the price reaches a specific point that is worse than the current price. Now, why on earth would you want to intentionally get a worse price? The answer is one word: momentum. Stop orders are the tools of breakout traders. These traders aren't looking for a small dip. They're looking for confirmation that a major move is underway. Let's go back to our euro to US dollar example. The price is hovering around 1.0870, and there's a known resistance level at 1.0890 that it has failed to break through several times. A breakout trader believes that if the price can finally punch through that ceiling, it will trigger a flood of new buy orders and the price will surge upwards. So their signal might say, "Place a buy stop at 1.0895. This tells the broker, "I don't want to buy now. I want to wait for proof that the bulls are in control. Only execute my buy order if the price breaks above that resistance and hits 1.0895. You're intentionally buying at a higher price because that price action serves as your confirmation. You're not trying to catch the bottom. You're trying to jump onto a moving train that has already proven its direction. The opposite is a sell stop. If there's a key support level at 1.0840, a trader might believe that if the price breaks below that floor, it will trigger a panic and a steep drop. So they place a sell stop at 1.0835. They are saying, "Only sell for me if the price breaks that support level," confirming that the bears have taken over. They are intentionally selling at a lower price to catch the momentum of a downward breakout. So to recap the entry: Limit orders are for betting on a reversal to get a better price. Stop orders are for betting on a breakout to confirm momentum. A simple market order is for getting in immediately but with the risk of slippage. A quality signal will often specify which type of entry to use. But a professional trade signal is never just one number. An entry point without a clear exit plan is just a gamble. It's like setting sail without a destination or a life raft. That's why every credible signal comes with two other critical pieces of information: the stop loss and the take profit. The stop loss, or SL, is arguably the most important number in any trade. It is a predetermined exit point for a losing trade. It's an order you place with your broker that says, if this trade goes against me and the price reaches this specific level, close my position immediately. I accept the loss. Let's build a full signal. Signal: buy euro to US dollar with a buy limit at 1.0850. The stop loss might be set at 1.0820. This means you are defining your maximum acceptable loss on this trade from the very beginning. If you get into the trade at 1.0850, but you were wrong and the price plummets, your broker will automatically close your trade at 1.0820. Your loss is contained. It's your financial seatbelt. It removes emotion from the decision to cut a losing trade. Without a stop loss, a small loss can turn into a moderate loss, and a moderate loss can turn into a catastrophic account-wiping loss. The third component is the take profit, or TP. This is the happy exit. It's a predetermined price target where you want to automatically close your trade and lock in your gains. In our example, the take profit might be set at 1.0910. If you enter at 1.0850 and the trade goes in your favor, as soon as the price hits 1.0910, your broker automatically closes the trade, and the profit is secured in your account balance. The take profit is your defense against greed. How many times have you heard stories of someone in a winning position, thinking it'll go a little higher, just a little more, only to watch the market reverse and turn their winning trade into a loser? A take profit order automates the process of taking gains off the table, according to your predefined plan. So, a complete professional signal looks like this. Instrument: euro to US dollar. Action buy. Entry type: buy limit at 1.0850. Stop loss: 1.0820. Take profit: 1.0910. When you receive this, you know exactly what to do. You place a pending buy limit order with your broker at 1.0850. At the same time, you attach two other orders to it: a stop loss order at 1.0820 and a take profit order at 1.0910. Once you've set this up, you can walk away from your screen. The broker will manage the entire life cycle of the trade for you based on those three price points. Either your stop loss will be hit, your take profit will be hit, or the entry price will never be reached and the order will remain unfilled. This structure: entry, stop loss, take profit, is the holy trinity of a disciplined trade. It turns a vague idea from a signal into a concrete, manageable plan with a defined risk and a potential reward. Understanding how to use market, limit, and stop orders to implement these three components is the absolute, non-negotiable foundation of executing any trading signal effectively. Now that you know the mechanics of placing a trade based on a signal, how do you decide how much to risk? How do you avoid blowing up your account on a single bad trade, even with a perfect stop loss? That's the science of position sizing, and it's where most new traders fail. It's the silent killer of trading accounts. The one variable that, when ignored, makes every other piece of analysis, every perfect signal, every brilliant insight completely worthless. Understanding position sizing isn't just an advanced topic for the pros. It is the fundamental bedrock of survival. It's the engine of risk management that allows a trader to withstand the inevitable storms of the market and live to trade another day. So let's break down this concept, not with complex formulas, but with a simple, powerful story. Imagine two traders, both using the exact same high-quality signal service. Let's call them Gambler Greg and Calculator Carol. Both start with a $10,000 account. The first signal comes in. It's a buy on the euro versus the US dollar. The signal provides a clear entry point, a stop loss 50 pips away, and a take profit target 100 pips away. Gambler Greg sees the signal and gets a rush of adrenaline. He's seen this setup before, he feels good about it. He thinks, this is the one. He decides to go big. He punches in an order for 2 standard lots. Now, for those unfamiliar with a standard lot of euro to US dollar, each pip movement is worth about $10. Greg does some quick, greedy math in his head. If this trade hits the 100 pip target, he's looking at a $2,000 profit, a 20% gain on his account in a single trade. His eyes light up, but what he conveniently ignores is the other side of that coin. The stop loss is 50 pips away. If the trade goes against him, a 50 pip loss at $20 per pip means he will lose $1,000. 10% of his entire account gone on one trade. He clicks buy, his heart pounding. Now let's look at calculator Carol. She sees the exact same signal, but she doesn't feel adrenaline. She feels a sense of process. She has one rule that she never ever breaks. She will not risk more than 1% of her account on any single trade. 1% of her $10,000 account is $100. That is her line in the sand. That is the maximum amount she is prepared to lose if this idea is wrong. It's a calculated business expense, not a catastrophic event. So her question isn't how much can I make? Her first question is always, how do I size my position so that a 50 pip stop loss equals exactly a $100 loss? She's not guessing. She's calculating. She knows that the distance to her stop loss is 50 pips. She knows her maximum dollar risk is $100. So she divides her dollar risk by her pip risk. $100 divided by 50 pips equals $2 per pip. Her entire goal now is to construct a position size where each pip movement is worth $2. She knows a standard lot is $10 a pip, that's too big. A mini lot is $1 a pip. So, to get to $2 per pip, she needs to trade 2 mini lots or 0.2 standard lots. It's a simple calculation. She places the trade and because the risk is defined, controlled, and an amount she's perfectly comfortable with, she walks away from her computer to let the trade play out. The market does what it does. It moves. In this case, an unexpected news event causes the euro to drop sharply. The trade hits the stop loss. Gambler Greg gets a notification on his phone. He's lost $1,000. 10% of his capital vanished. He feels sick to his stomach. His confidence is shattered. He immediately feels the urge to make it back on the next trade. A dangerous emotional state called revenge trading. 9 more trades like that and his account is completely gone. Calculator Carol gets the same notification. She's lost $100. 1% of her capital. She feels nothing. It was a planned, acceptable loss. It's the cost of doing business. Her account is now at $9,900. She is completely emotionally neutral and ready to analyze the next signal with a clear head. She can sustain 99 more consecutive losses just like this one before her account is wiped out. The statistical probability of that is astronomically small. This is the power of position sizing. It's not about the single trade. It's about your long-term survival. Now let's say the next signal comes through. This time it's a short on the British pound versus the Japanese yen. A much more volatile pair. The signal provider, recognizing this volatility, provides a wider stop loss. This time, it's 100 pips away from the entry. Gambler Greg, still stinging from his loss, is now scared. He doesn't want to lose another $1,000. So this time he just guesses a much smaller size. He puts on 0.5 lots. He has no mathematical reason for this. It's based purely on fear. Calculator Carol sees the 100 pip stop. Her rule doesn't change. She will risk 1% of her new account balance, which is $9,900. 1% of that is $99. Her maximum acceptable loss is now $99. The stop loss distance is 100 pips. So she does the math. $99 divided by 100 pips is 99 cents per pip. To achieve this, she needs to trade about 1 mini lot, which is roughly $1 per pip. She places her trade, sized perfectly to her risk tolerance. This trade turns out to be a winner. Carol's position, sized to risk $99, hits its take profit for a $200 gain. She not only made back her previous loss, but she's now in profit. Greg's emotional, fear-based position size also resulted in a win, but because he was just guessing, his profit was small and didn't even cover his previous loss. He's still in the red, and now he's confused and frustrated. Do you see the difference? Carol's approach is systematic. Her position size is dynamic. It adapts to the volatility of each specific trade setup. A signal with a tight stop loss allows for a larger position size. A signal with a wide stop loss forces a smaller position size. But the dollar amount at risk, that 1%, remains constant. This simple discipline is what separates amateurs from professionals. It transforms trading from a slot machine into a strategic business. provides psychological armor. When you know down to the dollar what your maximum loss on a trade is before you even enter, the fear dissipates. It's replaced by process. This also leads us to another critical concept that professional signal services will always talk about: the risk-to-reward ratio. In our first example, the stop loss was 50 pips, and the take profit was 100 pips. Carol was risking 50 pips to potentially gain 100 pips. This is a 1-to-2 risk-to-reward ratio. She was risking $1 to potentially make 2. This is the mathematical edge that traders look for. Think about it. If you have a 1-to-2 risk-to-reward ratio on all your trades, you can be wrong 2/3 of the time and still break even. You only need to win 34% of your trades to be profitable. When you combine a positive risk-to-reward ratio with a signal service that has a historical win rate of, say, 50 or 60%, the potential long-term positive expectancy becomes clear. You're putting the statistical odds in your favor. So when you receive a signal, you're not just getting a trade idea. You're getting the raw data you need to run your own risk management engine. The entry, the stop loss, the take profit, these are the inputs. Your account size and your personal risk tolerance, that 1 or 2%, are the other variables. You put them all together to calculate the one thing that truly matters: your position size. This is the piece of the puzzle that most people miss. They hunt for the holy grail signal with a 99% win rate, which doesn't exist. They focus entirely on the entry, the glamorous part of trading. But the professionals, the ones who last, they focus relentlessly on the exit, the stop loss, and the risk management that surrounds it. They know that managing losses is the only part of trading they can truly control. Profit is a potential outcome offered by the market. Loss is a certainty if not managed correctly. We've now covered how to dissect a signal and how to apply the single most important principle of risk management to it. You understand the mechanics of entry, stop loss, and take profit. You understand the science of position sizing. But all of this hinges on one critical assumption: that the signal you're receiving is coming from a credible, legitimate source. In an industry filled with hype and false promises, how can you possibly tell the difference between a seasoned professional and a clever marketer? How do you vet a signal provider and analyze their track record to see if they're the real deal? That process of due diligence is an art in itself, and it's what we're going to break down next. This is where the rubber meets the road. It's the single most important skill you can develop in this space, because it's not just about finding a signal provider. It's about protecting your capital from the countless pitfalls that exist. Think of yourself as a detective, and the signal provider is your person of interest. Your job is to gather evidence, check their story, and decide if they're credible before you ever consider following their lead. The first and most non-negotiable piece of evidence is a transparent, verifiable track record. I want to be crystal clear about this. A screenshot of a trading platform posted on social media is not a track record. A spreadsheet they made themselves is not a track record. Those are marketing materials. They can be edited, cherry-picked, and manipulated with ease. A real track record is one that is verified by a trusted, independent third-party service. The most common ones in the industry are platforms like MIFSpook or FX Blue. Here's how they work. A provider links their actual, live trading account directly to the platform. The platform then automatically and impartially tracks every single trade. The wins, the losses, the entry and exit points, everything. It's like having an independent auditor constantly watching over their shoulder. There's no hiding. There's no faking it. If a provider is unwilling to share a link to a verified third-party track record, that's not just a red flag. It's a giant flashing stop sign. Your investigation should end right there. But let's say they do provide one. Your detective work has just begun. Pulling up that MIFSpook profile is like opening the case file. Don't just look at the big green percentage number at the top. That's the headline, not the story. You need to dig into the details. The first thing to look for is longevity. How long has this account been trading? A track record of 3 weeks with a 100% gain could easily be a fluke, a lucky streak in a favorable market. A track record of 2 years with a consistent, steady gain tells a much more compelling story. It demonstrates that their strategy has weathered different market conditions, not just a single trend. Next, and this is arguably the most critical metric, you need to find the drawdown. The maximum drawdown percentage tells you the biggest drop the account has experienced from a peak to a trough. It is the rawest measure of risk. You might see a provider advertising a 300% total gain, which sounds incredible. But if their maximum drawdown is 60%, it means that at some point to achieve those gains, the account lost over half of its value. Ask yourself a tough question. Could you emotionally handle watching your account balance get cut in half? Could you sleep at night? If the answer is no, then that provider's risk profile is not a match for you no matter how high their returns are. A lower, more stable return with a 10 to 15% drawdown is often a much more sustainable path for most traders. Then you examine the profit factor. This is a simple but powerful ratio. The total money won divided by the total money lost. A profit factor of 1 means they've broken even. Anything above 1 is profitable. A profit factor of 1.5 suggests a solid edge, while anything above 2 is typically considered very strong. It shows that for every dollar they risk, they are, on average, making more than $1 back. But don't stop there. You have to look at the relationship between their win rate and their average risk-to-reward ratio. Many marketers love to flash a high win rate, like 85% of our trades are winners. That sounds amazing, but it can be dangerously misleading. A trader could win 8 trades and make $10 on each, for a total of $80. But if on their 2 losing trades they lose $50 each for a total loss of $100, they have an 80% win rate and are still losing money. Conversely, a provider could have a 40% win rate, which sounds mediocre. But if their winning trades make an average of $300 and their losing trades lose an average of $100, they are incredibly profitable. You must understand not just how often they win, but how much they win when they're right versus how much they lose when they're wrong. Once you've scrutinized the numbers, it's time to move on to the qualitative analysis. This is about understanding the human, the strategy, and the service behind the signals. Does the provider offer any analysis or justification with their signals? A signal that just says, "Sell pound sterling to Japanese yen now," is a black box. You have no idea why you're taking that trade. A quality provider might say something like, "Sell pound sterling to Japanese yen at 198.50. We're seeing a rejection of a key daily resistance level, combined with bearish divergence on the RSI. Stop loss at 199.20, target at 197.00. That context is invaluable. It helps you learn, it builds confidence in their methodology, and it allows you to see if their trading style, whether it's swing trading, scalping, or trend following, aligns with your own personality and goals. Next, assess their communication and support. Are they just a faceless entity firing signals into a channel, or are they building a community? Do they answer questions? Do they provide market updates or educational content? A provider who is invested in their members' success will often be more engaged and transparent. A provider who goes silent the moment you've paid your subscription fee is a major warning sign. And while you're evaluating them, keep your senses tuned for marketing red flags. Be deeply skeptical of anyone promising specific or unrealistic returns. Phrases like "our signals make 50% a month" are designed to prey on hope and greed. The financial markets are inherently unpredictable. Nobody can promise a fixed return. Be wary of high-pressure sales tactics like "only 2 spots left" or "price doubles tomorrow." A legitimate, valuable service doesn't need to create false urgency. And perhaps the biggest red flag of all is the lifestyle marketing. If a provider's social media is filled more with rented Lamborghinis, luxury watches, and private jets than it is with actual market analysis and charts, you're likely looking at a marketer, not a trader. They are selling you a dream, not a sound trading process. A professional's focus is on the markets, not on flaunting wealth. So you've done your research. You've found a provider with a long-term verified track record, a reasonable drawdown, a solid profit factor, a clear strategy, and professional communication. The final step before you risk a single real dollar is the test drive. Open a demo trading account with a broker. It's free and it uses virtual money. For at least 2 weeks, ideally a full month, you will follow every single signal from that provider on your demo account. Do not skip any. Do not cherry-pick the ones that look good. You need to simulate the experience perfectly. This trial period will reveal crucial information the track record can't. First, you'll see if you can realistically execute the trades. Are the signals coming at 3 a.m. in your time zone? Is the market moving so fast after the signal is released that you're consistently getting a worse price, an issue known as slippage? Second, you'll get a feel for the emotional rhythm of their strategy. How does it feel to go through a losing streak of 3, 4, or 5 trades in a row, even with fake money? This psychological test is just as important as the statistical one. If you can't handle the emotional swings on a demo account, you certainly won't be able to handle them when your hard-earned money is on the line. This entire process, demanding verification, analyzing the metrics, assessing the strategy, and running a demo trial, is your shield. It's what separates an informed, strategic decision from a blind gamble. It's not about finding a perfect, flawless provider who never loses. That person does not exist. It's about finding a competent, professional provider whose methodology, risk appetite, and communication style are a compatible match for you and your personal financial goals. But once you've found that match, the work isn't over. Simply copying and pasting signals is not a plan. How do you integrate these external signals into your own personal risk management framework? How do you decide how much to risk on a trade that isn't based on your own analysis? This is the final critical bridge you must cross, the one that takes you from being a passive follower to an active manager of your own trading business. And navigating that crucial step is exactly what we're going to break down in our final part. So, how do you evolve from a signal consumer to a signal commander? This isn't just a change in mindset. It's a structural shift in your entire approach. It's the difference between being a passenger in a car and being the one with your hands on the wheel, your eyes on the road, and your foot on the gas. The signal is just your GPS, a valuable guide, but you are the driver. The first, non-negotiable step in this evolution is forging your own personal trading plan. Think of it as the constitution for your trading business. It's a written document that governs every single decision you make, removing emotion and guesswork from the equation. A signal might arrive, flashing an opportunity, but it must first pass the laws laid out in your constitution. What goes into this document? It starts with ironclad risk management. Before you ever think about profits, you must become a master of preservation. Your plan should state, in no uncertain terms, the maximum percentage of your capital you are willing to risk on any single trade. For many seasoned traders, this number is between 1 and 2%. That's it. This rule is your ultimate defense against a catastrophic loss. A bad signal, a volatile market, an unexpected event. None of it can wipe you out if you adhere to this primary law. Next, your plan must define your trade management protocol. A signal gives you an entry, a stop loss, and a take profit. But the market is a living, breathing entity. What's your procedure if a trade moves halfway to your profit target and then stalls? Do you take partial profits and move your stop loss to your entry point, creating a risk-free trade? What if the price is rocketing in your favor, showing momentum far beyond the initial target? Do you have a rule for using a trailing stop to capture more of the move? These are not questions you answer in the heat of the moment. They are predetermined strategies outlined in your plan. You are no longer just executing a signal. You are actively managing a position based on your own rulebook. This leads to the most crucial element of your trading plan, your signal filtration system. You will not take every signal that comes your way. That's what a robot does. You are a CEO. You will develop a checklist, and a signal must tick the right boxes before you allocate a single dollar of your company's capital to it. This is where you begin to merge the signal provider's analysis with your own. This synergy is a concept professional traders call confluence. It's the idea that the highest probability trades occur when multiple, independent factors all point in the same direction. The signal is just one factor. Your job is to find the others. For instance, a signal provider sends a buy alert for the euro against the US dollar. That's your first piece of evidence. What's the next? You pull up your own charts. You perform your own basic technical analysis. Is the price bouncing off a major support level that you've identified? Is it respecting a long-term upward trend line? Is a key moving average providing a floor for the price? If your own analysis aligns with the signal, that's a second powerful factor, that's confluence. Then you can add another layer. What's the fundamental picture? Is there major economic data coming out of Europe that analysts expect to be positive? Has the head of the Federal Reserve in the US recently made comments that suggest a weaker dollar? If the economic narrative supports the trade, that's a third layer of confluence. The signal is no longer just a suggestion from a third party. It's a hypothesis that you are now confirming with your own independent research. You are building a comprehensive case for the trade, just as a lawyer would build a case for court. The more points of confluence you can find, the signal, your technical analysis, the fundamental backdrop, overall market sentiment, the higher the potential quality of that trade setup. This process transforms you. You stop asking, is this signal good? And you start asking, does this signal align with my high probability criteria? You see the shift? The power has transferred from the provider to you. Now, how do you refine this entire process, track your performance, and ensure you're actually improving? You do it with the single most powerful tool in a trader's arsenal, a detailed trading journal. This is not a diary for your feelings. It's a performance analytics database for your business. It is the one thing that separates consistent, long-term traders from the 90% who fail. For every single signal you consider, you log it. If you take the trade, you record the date, the currency pair, the entry price, your stop loss, and your profit target. You write down the confluence factors you identified, the reasons you decided to approve this trade. Then you track the outcome, the profit or loss in dollars and in pips. But here's what's even more important. You also log the signals you didn't take, and you write down why you rejected them. Rejected euro to US dollar buy signal, because it was trading directly into major daily resistance. Ignored pound sterling to Japanese yen sell signal, due to extreme market volatility ahead of major news. After a month, you have a rich data set. You can now sit down not as a trader but as an analyst of your own performance. You review your journal and the patterns will be astonishing. You might discover that one signal provider is incredibly accurate during the London session, but performs poorly during the New York session. You might find that your best trades consistently have at least 3 confluence factors. You may see a devastating pattern of exiting winning trades too early out of fear, or holding on to losing trades too long out of hope. This journal is your feedback loop. It's how you identify your weaknesses and systematically eliminate them. It's how you recognize your strengths and double down on them. Without this data-driven review, you are flying blind. You are doomed to repeat the same mistakes, forever blaming the signal provider or the market, instead of refining the one thing you can control, your own process. Ultimately, the journey with trading signals is a phased one. You begin with cautious trust, using a demo account to verify a provider's claims. You then move to live trading, acting as a disciplined employee, executing a proven system. But the final and most rewarding stage is when you ascend to the role of CEO. You use the signals not as commands, but as high-level intelligence from a team of analysts. You take that intelligence, you vet it against your own research, you check if it aligns with your company's master plan, and only then do you authorize the allocation of capital. Over time, something remarkable happens. Through your own analysis, your study of confluences, and your meticulous journaling, you begin to develop an intuitive feel for the market's rhythm. You start seeing the patterns before the signal arrives. Your own analysis becomes so sharp that the signals simply become a confirmation of what you already suspect. This is the end game. The goal was never to follow signals forever. The goal was to use them as a scaffold, a structured learning tool, to build your own expertise until you no longer need the training wheels. We've covered a tremendous amount of ground in this series. We started with the simple question, what is a signal? And have journeyed all the way to building a sophisticated, data-driven trading business. We've dismantled the myths and replaced them with a process, a methodology for using signals intelligently, safely, and effectively. The path of a trader is not an easy one, but it is a path of immense personal and financial growth for those who treat it with the seriousness it deserves. Trading signals are not a shortcut to wealth, and anyone who tells you otherwise is selling you a fantasy. But they can be an incredible accelerator for your learning, a source of disciplined trade ideas, and a powerful component in a well-built trading plan. The key, as we've seen, is you. Your discipline, your commitment to risk management, your dedication to analysis, and your relentless focus on constant improvement. The signals are a tool. You are the craftsman. Now it's time to get to work.